Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with us. Jim, sometimes you call it right, sometimes you call it wrong, but the last couple of weeks you've been dead on with this dollar and gold. But it looks like we might be at an inflection point. So Jim Welsh, good to see you.
Well, it's good to see you, Blake. It's Friday, and we're a Friday ahead of a 3-day weekend, so to speak.
Yeah. Yeah, it's it's
For
President's
regular
Day.
people.
For those of you that are
Yeah.
not in the United States, it's President's Day. I'm sure if you're in in the European Union, you are celebrating our President's Day. I'm sure of it. I can almost guarantee it. So Jim, a lot of crazy price action this week.
Yeah.
We've seen the dollar finally move. We've seen gold have a precipitous move lower. Stocks have been relatively calm once
Yeah.
again. So, but we've had all this great data. I mean, between non-farm CPI, producer prices, retail sales, really,
Yep.
very, very robust data. Yet the stock market seems to be brushing it off. What do you make of all this?
Well, as we've talked really the last few weeks, I think the stock market has shifted away from the Fed being the dominant dynamic driving events, at least in the equity market, to the economy. Because the view is like, well, the Fed is almost done. One or two more quarter point hikes, that's going to be about it. In the meantime, the worries about a recession. Last summer, as you recall, 2 quarters in a row, everybody was near hysterical. Oh my God, we're going into a recession, and the Fed's tightening rates, and oh my God. At that time, I pushed back very strongly. We're not in a recession. There won't be a recession in 2022. We've seen third and fourth quarter GDP come in 3.2, 2.9, and the pendulum now has swung from, oh my God, we're on the cusp, if not in a recession, to, we really don't need to worry about a recession. And if by chance one shows up, it'll be really, really mild and almost painless. And so I think the stock market is listening more to economic data, which suggests that the economy is okay. Earnings are expected to be up 10% this year, and that's what it's feeding off of. And it's allowed the market, if you will, to ignore higher rates and the stronger dollar and so forth. I think, again, as you know, I think there is going to be a recession as we get past mid-year. And at that point in time is really where the market will face the test, where we see economic data showing more and more signs of weakening. All of a sudden, earnings then have to be marked down, and that's going to happen against a backdrop where the FOMC isn't going to blink. They're not going to back down as soon as we see signs of slowing, because this is exactly what they want, is to see slowing, a slackening in demand, because in their view, that's going to equate to a longer lasting decline in inflation.
Well, let's start off and let's talk about the CPI print. Let's go there first. What do you make of this? This is a chart that you brought. Tell us about what your feelings are here.
Well, in the February 1st macro tides, I had the Fed's not going to blink, and the subtitle was "Inflation may not be dead yet." And I went through a lot of mathematics and so forth, explaining that the rebound in energy prices in January, along with the decline in December, which originally was reported as 0.1, the Labor Department completely redid the stats for the CPI, the composition. So the minus 0.1 for December became a plus 0.1. But my thought was we were going to see the CPI increase by at least 0.3, maybe more. And that would look pretty sharp, if you will, after a 0.1 decline. So my expectation was that we would see a pop in the CPI, and that would kind of, cause people to take a bet, like, oh my goodness, maybe inflation is just not going to continue to drop like a stone. And it really has had that impact, because we saw the jobs report, the CPI with the retail sales number this week were like a 1-2 punch. And so all of a sudden we see that ripple through a lot of the interest sector of the financial markets. In the meantime, yes, the S&P's backed off from a high of 41.95. It got down to 40, 49. So it was down 150 S&P points in the last handful of days. So it hasn't been completely immune.
Finally, it started paying
Yes.
closer attention.
Yeah, I think what happened was with the CPI, it's like, whoa, all of a sudden, as you can see on this chart, this is the probability of a rate hike in 2023 June. And back before the employment report, you can see it was like at 4 or 5%. The employment report called it jumped from 5% up to 40. Then there was a little dip to about 39%. And then all of a sudden the CPI comes out and it's up to 59%. So you've had a series of data points that have really pushed people to, whoa, wait a second. The idea that the Fed's going to be cutting rates, which I've ridiculed all along, okay?
Yeah.
That we were going to see rates come down in the second quarter. Then it was June. And then it was last week was August. And now the Fed funds futures are almost at a point where they're pretty much at 5.1% for the end of this year. 3 weeks ago, they were 75 basis points below where the Fed. They weren't going to peak as much, and they were going to drop by over 50 basis points. So we've really seen the data ripple through expectations in the Treasury market. And this is a reflection of it. 2 or 3 weeks ago, no one thought the Fed would be raising rates in June. Now all of a sudden we're up to almost 60%. Whether they, this is all conjecture. I think, if you look at the jobs report, retail sales, January is one of the warmest Januaries we've seen in a very long time. In New York, they didn't have snow in January. First time in 50 years. So what happened was people were able to go out after, at the end of December, as you remember, there was this huge storm, super cold, everything else. In addition, a lot of people more and more, instead of buying a gift, they do a gift card. Well, if you buy a gift, it shows up in retail sales for December. If you buy a gift card, it doesn't show up until people spend it. So what we saw retail sales in December were kind of muted. And then all of a sudden, this huge jump in January. And I think in part that was a combination of weather, people, using gift cards and so forth. So we're going to see that big number in January. It's going to soften in coming months.
I don't know. I don't know, Jim, because there's people like myself that I keep finding gift cards from like years ago. I need to put those to use. Now you're reminding me.
Yeah, more and more people, let's not charge. Let's dig through every drawer we can find to find an old gift card. But anyway, my point is, you always, with all these data points, you got to kind of look under the surface and not just accept them at face value. So my only point is, in coming months, we're going to see the super strong numbers for January. They're going to soften. In my mind, there's just no doubt about that. And how are markets going to react? Oh, our worries that the Fed was going to go 50 basis points in March, that's going to go away. I personally don't think they're going to go 50, but you had Bullard and Meister this week talk about, well, I would have been in favor of 50 basis points. Neither one of them are voting members. And I think the Fed is, they're going to get another employment report. They're going to get retail sales before the March 21st meeting. And another CPI report.
Still a lot of data to come.
They're going to stick.
Yeah.
I'm sorry?
Still a lot of data to come.
Yeah, and I think we're going to see the data, the super strong data we just got, we're going to see that stuff all soften. I think they're going to stick with 25 basis points because they don't want to go into a recession if they can help it, because that'll force them to shift. All right, here's the Fed's balance sheet. No one talks about it very much because it's kind of just been operating in the background, and all these other data points are kind of causing it. But the correlation is pretty amazing here in terms of changes in the Fed balance sheet. They're intending to continue to shrink the balance sheet. And I think this is another one of those forces as we get past mid this year. We're going to see the economy, I think, flirt with recession, if not go into a recession. And this is maybe one of the background aspects that contribute to that. Again, lending standards went up in the fourth quarter. Whenever they've gotten over 20% of the banks tightening lending standards the last 30 years, always a recession. In the fourth quarter, they hit 43%. So now we're seeing banks start to choke back the amount of liquidity. The Fed's raising the price. Banks are cutting back on lending, and they're also raising the spread on loans. So here we have the Fed jacking up rates, and now the banks are jacking up rates a little bit more on top of it. Oh, you want that loan? We'll give it to you, but you're going to pay an extra 50 to 100 basis points over prime to get it. And so all this stuff will have an impact.
Yeah, it will. So what you're saying here is this dislocation of the market here eventually will correct itself, and we should see the S&P catch up to the reduction of balance sheet from the Fed.
Yes.
Yeah.
And again, as you know, my take is I think sometime this year we're going to see the S&P back at the October low. And if we really do flirt with the recession, as I think is likely, 3,200 becomes a real possibility.
Well, before we get into what your technical targets are, I'm glad you brought this chart, because this has been the talk of the markets have been, this 0 days till expiration, these intraday options. What do you make of that? All of that? I mean, is it a real thing, and can it have an effect on equities moving forward?
It can. It does obviously in the very, very short term, intraday, add amplitude to all the moves, whether it's down or up. Basically, what's happening is if you look at the most active options out of the top 10, 8 or 9 of them will be S&P 500 intraday options. So what's happening? Hedge funds have really jumped in. So you can kind of see that red on the very, very far right of that chart, how much they've spiked just in the last 5 or 6 months. Hedge funds okay, I'm going to take an option position out 3 months because this is the economic scenario that I think is going to play out. And of course, people have been wrong over the last 6. They thought we were going into recession, So instead, it's you know what? I can buy an option for 40 cents that expires later today. And if we get, a good report and the market starts rallying, hell, I can maybe sell it for 60 to 80 cents later today. And so we've seen this huge concentration of, if you will, money flowing into these short dated and the 1 day expiration. You can see are the green. So we're 50% of all the volume is focused basically on 48-hour trading. Do these people care anything about inflation and what the Fed's going to do? No, they're pure momentum players. My point is, if I'm right and the economy shows real definitive signs of weakening mid-year and beyond, and the prospect of recession becomes more likely, as the market reacts negatively to that, as mutual fund institutions and so forth begin to do some selling, these guys can amp the intraday declines significantly. Markets always go down faster than they go up. So this is adding potentially, gasoline to a fire later this year. So a lot of people don't remember the 1987 crash. One of the main ingredients was a concept called portfolio insurance, where pension funds were taught the idea that, when the S&P is down 3% from a high, you sell S&P futures to hedge some of your portfolio. Then when it's down 5%, you sell a little bit more. Well, what happened on the day of the crash on October 19th, 87, was the S&P futures were trading at 5 to 10% below the cash. And these pension funds were still selling futures. And so the arbitrage guys would come and say, okay, I'm going to buy the S&P futures because it's selling at a huge discount. And then I'm going to sell the cash to bring the two back together again. And that's one of the main reasons why you had the crash in 1987. In 1986 and early 87, there were a number of very sharp breaks that took place. And then all of a sudden on October 19th, it all manifests. So to me, this is one of the things that could really contribute more to downside action. If the fundamental analysis that people view that they hold, we don't have to worry about a recession. If that really gets challenged, this stuff is going to, I think, make the decline more sharp and more time compressed because of the money that's involved here.
Interesting. All right. Well, let's talk about, the S&P and what you see as a technical picture right now.
Yeah.
In the S&P. So,
okay. So I think today's kind of an interesting day. The S&P took out the recent low. I think it had a low at 4,061 on February 10th. Before we came on, the low was 4,049. But things like the Russell 2000, the Value Line Composite, the Dow, the transports, we're all holding above the February 10th low. So that concept of intermarket divergences, where you look at various averages. So right now, the low today in the S&P, I think, could be pretty important. My overall view is that as long as we keep getting decent economic activity, it feeds that narrative that, hey, the economy's okay, earnings are okay, I want to own them. So my belief is we're going to see a rally above 41.95. And, it could get up towards 42.50. Or even 4,300. again, if I'm right, and the next jobs report comes out and it's only 150,000 or, under 200,000, and then retail sales aren't as strong and all that, well, that'll take that 50 basis point cut off the table. And that might be the trigger that we see in terms of the S&P having kind of a spike high in the first part of March.
Yeah.
So that's my expectation. 4,015 was the initial high off the December 30th. That first rally got up to 4,015. That's kind of like a wave one idea. I think we should hold above that if this more short-term bullish case is going to hold. So I think we see more strength the first quarter. It's after the first quarter that I think reality will start to set in.
All right. So let me ask you this, where would you say you're wrong? I mean, where is it where the market's turning lower and you're like, shoot, that was a bad call?
Well, that 4,015. I don't think the S&P should take out 4,015.
Got it.
So again, for me, I'm more concentrated on, all right, I think there's a high coming. And if things play out as expected, I think not only is that a wonderful opportunity to do some selling into and reducing exposure, but I think potentially taking a short trade. Because right or wrong, my conviction is high about the second half and the coming weakness and the psychological shift we've seen from worries about a recession last summer to, gee, we're not worried so much. Okay, Treasury yield, 2-3 weeks. Hey, we got an intermarket divergence. The 10-year went to a lower low, the 30-year didn't. And my conclusion was we're going to see the 10-year make a run at 390 and the 30-year make a run at 399. Today, the 10-year hit 390. So it got right to the expectation. The 30-year fell short. So in a sense, you kind of got another intermarket divergence where one is up at a higher level or about where it was, and the other one's holding below. I think potentially we've seen a fairly significant move. I mean, before the jobs number, I think the 2-year yield was at 405. Last I looked, it was like 466 to 470. I mean, that's a heck of a move in 2 weeks. So I think near term, we're seeing potentially Treasury yields top out. We'll see them come down a little bit, which is another backdrop for maybe the market could rally. The one thing, and I'll show this next week, there's like the VIX for the stock market. It's called MOVE.
The MOVE
index,
yeah.
Okay. Well, there was a nice downtrend from the highs that we saw in the MOVE index and in Treasury yields back in October, November. In the last 3-4 days, it's broken out above that downtrend, Blake. So to me, the risk here is that we may see yields after a little bit of a dip push even more to the upside. In other words, this move higher in yields isn't completely done yet. And I'm basing that on really the MOVE index because that's been a pretty good indicator of intermediate term trends. So I'll try to remember to bring that next week and we can kind of talk about it. Okay. The dollar on February 1st, to me, the dollar was approaching a low on February 1st as Powell was talking after the the FOMC meeting, spiked down to just under 101. To me, it was like, okay, this thing is making a low. I think there's higher yet to come, but I think we're nearing a short-term high in the dollar index. So I think we're going to eventually get up to that 106, 107.50. But I think you could get a pullback in the next handful of days or so before we see another move higher. So I think the dollar has more upside. I just think short term, it's made a pretty big move in a relatively short period of time.
Yeah, and it has, and I guess that would feed into your backdrop with equities moving higher. The dollar would probably have to soften as a result, right?
Yes. Yeah. I mean, it doesn't have to pull back much, but you just remove that upside pressure from that the dollar is providing. Okay. Gold, over the last 2 weeks, I said, okay, the dollar's near a low. Silver was underperforming. I said it was all setting up for a decline in gold. And the first target was 1825 because that was the 382. It traded down on the cash. This morning it traded down to 1819, I believe. So we're at a point where it kind of needs to hold here. I think there's a scalp trade for somebody who looking for at least at a minimum a rebound of this 100. What it went from 1959 to 1819, $140. So the 382 retracement's 1872. The 50% is 1889. Is there a chance Gold, gold has this tendency to make the biggest part of the move right near the end of things. So there's a chance it could get above 1859. I just think in the near term, we've had a pretty good correction. See a bounce to retrace that seems likely. Getting below today's low opens up gold for another $40 or so to the downside. So again, all these markets I think are at potentially a very short-term pivot point where we see the dollar pull back, Treasury yields come down, gold pops, and the S&P can rally as well.
Well, Jim, like I said, you've been spot on recently, and so kudos to you. How do traders follow your work more closely? Because they hear you once a week here on the Trader Summit, but how do they get your technical review and your work?
Okay, macrotides.com. You can subscribe there, or if you'd like to get a sample or two, send an email to jimwelshmacro@gmail, and I'll send you so you can kind of see how I blend economics, monetary policy, technical analysis. And obviously, we're at the time where all three of those aspects are, more and more important because of where we are in terms of the economy and monetary policy. So that's how you do it.
All right, Jim. Well, we appreciate you here every week. If you guys and gals like what you hear, make sure you give him a thumbs up. Subscribe to the channel down below so you don't miss any of this exclusive content we have with Mr. Jim Welsh from Macro Tides. Jim, have a great weekend and have a great President's Day. And we'll catch you next week.
Thank you. You got it, buddy.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.